Liquidity, market structure, fair value gaps, and supply and demand are often taught as isolated concepts. But real execution happens when all of them align inside the same market narrative. In this video, I will show you a simple framework that ties everything together using market structure, discount positioning, liquidity sweeps, fair value gaps, and demand zones inside one institutional model. Welcome back to a ComLucro channel. We will break this down step by step, then walk through real chart examples so you can apply the same process on any market and any time frame. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let us begin with the foundation, market structure. Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high. This movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHoCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHoCH. This is a brief overview of how break of structure, BOS, and change of character, CHoCH, work together to describe shifts in market direction. Now let us apply this directly to the chart and see how structure guides our bias. If we look at this chart objectively, it becomes very clear that the market is trending upward. Price continues to print higher highs and higher lows again and again. That alone defines the overall direction. So, in a clear uptrend, what do we expect price to do next on the daily time frame? Simple. We anticipate another higher high. When trading market structure, the objective is very straightforward. Each time, we aim to trade the next impulsive move toward a new higher high. If you observe the chart carefully, you will notice something important. The market does not move in a straight line. We see strong impulsive moves, and between them, we get pullbacks. Those pullbacks are the moments when price slows down and retraces before continuing higher. That is why I highlight this pullback area, to clearly show where price is temporarily pausing. The strategy is simple. We want to enter during the pullback, not after the large move has already occurred. If we mark the daily high and the daily low, we define a daily swing range. And when we drop down to a lower time frame like the 4-hour, we can clearly identify the swing low and swing high within that range. Our main objective remains the same. We want to capture the beginning of the next impulsive move upward, because that is where the strongest expansions occur. If you look back at the chart, The largest pushes always begin after the pullback completes. So the real question becomes, how do we know when this pullback zone has ended and price is ready to move higher again? That is where the next confluences come into play. And with that, our first confluence is already evident. We are trading within a bullish market structure, from this low toward this high. Now we move to the next confluence, which is the premium versus discount concept. Premium versus discount is simply measured using the Fibonacci retracement tool. For this specific model, we will only use the 0, 0.5, and 1 levels. No reverse levels, no additional ratios. We keep it clean and simple. The 0.5 level represents the equilibrium point of the range, separating premium from discount. Below that midpoint, we consider price to be in discount. Above it, we consider price to be in premium. This allows us to align our entries with logical positioning inside the range. It is important to mention that there is also the OTZ, or optimal trade zone, which includes additional Fibonacci levels and can offer more refined entry areas depending on your trading style. We cover that in detail in another video in this series, where we break down the full structure and how those levels can improve precision. For now, we focus strictly on 0, 0.5, and 1 to maintain clarity and execution speed. What we want to see is very straightforward. Whenever the market creates an impulsive move upward, I expect price to retrace. During that pullback, I want price to correct at least to the 0.5 level. The first time, price pushes up and then retraces cleanly to the 0.5. The second time, the same sequence repeats, another impulse followed by a structured retracement. Now, the third time, price pulls back even deeper, once again moving below the 0.5 level. This provides our second confirmation. Price is retracing into discount, which reinforces the idea of a potential long continuation. If trading were based only on market structure and premium versus discount, it would seem simple. But these two confirmations are not enough. The next two confluences show us when the pullback is truly finished and price is ready to move higher. Now we move to the third confluence, liquidity. So, trader, what is liquidity and how does it actually behave in the market? To answer that, we need to approach it from a practical perspective, focusing on how smart money interacts with liquidity in real trading conditions. Before moving into patterns and execution, it is important to understand what these concepts mean on the chart and how they influence price behavior. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap. Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional, it is essential. These zones, where orders are concentrated, reveal how the market is likely to behave and help you avoid unnecessary losses. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Now, instead of keeping this discussion theoretical, let us apply it directly to the chart and see how liquidity behaves in real conditions. Here is an example. We observe a brief period of consolidation, Liquidity rests below that low. Price moves downward, takes that low, and then continues pushing higher. Now, let us simplify the chart to maintain clarity. All we need to see is an impulse upward, a retracement downward, and the expectation of another impulse to the upside. This expectation is logical because first, we have a bullish market structure. Second, price has retraced into discount using the 0.5 Fibonacci level. And third, liquidity has been swept. If we zoom into the impulse, since that is where liquidity is most clearly identified, we can see two instances where liquidity was taken. If this is difficult to recognize on this time frame, simply move to a lower one, such as the 1-hour chart. There, the structure becomes obvious. Price forms ascending lows repeatedly. Once those ascending lows are taken, price reacts, pauses briefly, and then moves higher. Now we return to the 4-hour chart, fully aware of where liquidity was located and that it has already been cleared. That completes the third confluence in our checklist. Before moving into the demand zone itself, there is another important concept we need to understand: fair value gaps and market inefficiencies. A fair value gap is a 3-candle pattern that reveals an imbalance in price delivery, creating a gap between the first and third candles. A fair value gap forms when price expands aggressively and the candle wicks fail to fully overlap, leaving behind an inefficiency in the market. To make this concept clearer, let us compare two different price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the candles, which creates a fair value gap. On the right, the candles overlap correctly, meaning no imbalance was created. These inefficiencies are important because strong impulsive moves often leave behind areas where price delivery becomes unbalanced. As a result, the market will frequently retrace back into part of the fair value gap before continuing in the original direction. Fair value gaps can also act as reaction areas during pullbacks, similar to support and resistance levels. In many cases, price revisits part of the imbalance during the retracement before continuing the expansion. This is why fair value gaps are often used together with liquidity, market structure, and demand or supply zones when building high-probability trade setups. Now we move to the fourth and final confluence, which is the supply and demand zone. The simplest way to understand a demand zone is through order flow. We focus on the strong sell move that occurred just before a powerful buy move, especially when that buy move caused a break in market structure. Traditionally, many traders are taught to mark a very small demand zone, or just an order block, usually the last candle at the bottom of the move, or a single imbalance candle. Then extend that zone forward and look for buys there. This approach is common in smart money concepts, but the reality is that the market is not perfect. Instead of trying to be overly precise, what we want to do is mark the entire sell-off that took place before the strong move upward. Once price clearly reacts from that area, we can say we have connected with a demand zone. Now, that is only one part of identifying demand. The second part, and the more important one, is waiting for a change of character, because that is where the real demand zone for entries is formed. You can see it clearly here that a change of character happened on the lower time frame. Price pushes down, pulls back, then pushes down again with a wick. That move takes liquidity, and immediately after that, we get a strong push upward. That strong reaction is the key. What does that create? It creates a sell before the buy, which defines a high-quality demand zone. Strong demand zones almost always sweep liquidity before price moves away from them. And notice something important here. The strong displacement that forms immediately after the change of character also leaves behind a fair value gap. This is important because impulsive moves often create inefficiencies during expansion, and those imbalances can later act as reaction areas during the retracement. That is why fair value gaps are commonly used together with demand zones to help refine entries and identify high-probability continuation setups. So now, for the next upside move we are expecting, our plan is simple. We wait for price to retest that demand zone. When price returns into the zone, that is where we look for our long entry. The entry is taken at the top of the demand zone. the stop loss is placed below the demand zone, and the target is always a mechanical 1 to 2 risk to reward. Nothing complicated. And even if we had placed the stop loss below the last liquidity that was taken, we still would have had a solid risk to reward. And, as you can see, price retests the zone and then continues upward, reaching our target. This is how the strategy works, using 4 clear confluences that can be applied to any market, any pair, and any time frame. All right, let us go through another example step by step. First, we need to determine the overall direction. For that, we always start with the higher time frame. In this case, the 4-hour chart. On the 4-hour time frame, price is clearly forming higher highs and higher lows, which confirms a bullish structure. We mark the swing high and swing low to define the current range. A break of structure has already formed, so our directional bias is confirmed. Next comes premium and discount. Drawing from the swing low to the swing high, we can see that price is currently trading in the discount zone. This gives us a strong reason to look for buying opportunities. That is our second confirmation. Now, let us talk about liquidity. In this impulse move, there is no clear liquidity yet. It may develop during the pullback, or it may become easier to identify on a lower time frame. At this point, the fourth step begins to emerge. The demand zone becomes clearly visible, positioned perfectly within the discount area. So, we shift to the 1-hour chart for refinement. On the 1-hour time frame, the structure remains bullish, and price is still within the discount area. Now we refine the 4-hour demand zone into a more precise 1-hour demand zone. After refining it, we remove the higher time frame zone to keep the chart clean. At this level, liquidity becomes clear. We can see inducement forming, with resting liquidity that is likely to be swept before the real move begins. The expectation is simple. Price sweeps liquidity, taps the demand zone, and then pushes upward. With all confirmations aligned, we place a buy limit at the beginning of the demand zone and position the stop loss just below it. The target is set at the previous swing high. As price retraces into the demand zone, the entry is triggered, followed by a strong bullish expansion that creates another break of structure. This entire framework is built around 4 simple steps: direction, discount, liquidity, and demand. Now, there is another interesting execution model that could also have been used in this scenario. Notice that after price reacts from the lower time frame demand zone, it creates a strong bullish displacement, which leaves behind a fair value gap during the expansion. This fair value gap could have been traded as an alternative entry model. In this case, we mark the fair value gap on the chart, place the entry at the 50% level of the gap, commonly referred to as the consequent encroachment, and position the stop loss below the low of the lower time frame swing. The target remains simple and mechanical, always aiming for a 1 to 2 risk to reward ratio. This becomes a very useful alternative in situations where price reacts too aggressively from the original demand zone and does not allow an entry at the initial order block. This entire setup follows just 4 simple steps: direction, discount, liquidity, and demand. Master these 4 confirmations, and your analysis becomes clear, structured, and high probability. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.